Today we'll see that for next 10 or 20 year, which is that sector which can outperform all the sectors, and why it is so, and what are the stocks, which are the stocks in that particular sectors on which you can bet for next 10 or 20 years. So I will explain you in detail why I am telling this and how to identify those stocks, those next 10 to 20 years best stocks from that sector. So I am Vikas from Trade with Books, and we'll start with summary of economic survey. Economic survey is released in parliament just before the budget day. In that it is shown that India is growing with a GDP of 6.4%. 6.3 6.8% in 26. So we can assume between 6 to 7% India is growing. India's GDP is growing, means the whole products and services which are formed, which are made in a year, that will grow by 6 to 7%. Now what will happen when GDP will grow by 6 to 7%? We will reach to that sector and stocks, but first you have to understand this, then only you will enjoy the video also, and you will understand the concept. You will have some faith in that concept, that okay, he is telling the real thing. When GDP grows, what happens? Per capita income increases. Money in the hands of people increases, because overall economy will develop, means your people's lifestyle will also enhance. Not everybody's, but most of the people's. So you can say on an average per capita income increases when GDP will grow. So currently India's per capita income is $2,900, whereas China it is $12,000, and USA it is $86,000. So we are like 4 times. When we'll grow, that time we will reach to China, and almost 30 times when we'll grow, we'll reach to USA. So we have lot of scope. We have lot of scope. We have to work on that. When our per capita income will increase, what will change? You may have seen, when people will get more money, their salary increases, they will start taking more credit cards, more loans, more EMIs, homes, cars, everything they will start buying. So this is our main philosophy in today's video. What I am talking is, in next 10 to 20 years, the finance companies will gain the maximum, because when GDP is growing, India's per capita income is also growing. We are a growing country. So when per capita income grows, people lifestyle changes, and they will use more financial products like loans. Then they will take credit cards and other types of car loan, home loan, many types of loan people will take. Currently in rural economy and all, people don't take credit cards, and lot of new financial products are coming nowadays. So that also will grow with AI. AI also will increase the number of financial products. So that will increase the financial depth also. More people will, it will be more inclusive. More people will join the financial ecosystem. So these all things are directing towards that finance companies will lead this market, and finance companies will get the major chunk of the GDP growth. So with this regard, with this, keeping this in mind, we will go that how much a finance company should grow. What is the base level? Like what are the criteria you have to see in finance companies? So for that, I will take you to the credit growth of India. What is the credit growth in India? So in Google search, if you see, you will see that 11.5% year on year is the credit growth in India. And for banks, 13 to 13.5% is the credit growth for 2024 and 25. Anyway, it is said that credit growth in any country is almost 1.5 to 2 times of the GDP growth. So if GDP growth is 7%, you can assume around 14% will be the credit growth. Credit growth means the amount of credit people are taking will grow by 14%. Now this is the combination of all finance companies. So first thing you have to see is, which is the finance company which is going by more than 14% or 13%. That will be your first criteria. The more is the growth, the better it is. That is called the top line growth, the sales growth. In that profit and loss statement, the first line is revenue growth, that is sales growth or the top line growth. That should be more than 15%. That is our first criteria, that revenue growth or top line growth should be more than 14%. Now next criteria is, for any finance company you have to see return on asset. You should not see ROE or ROCE, you should see return on asset, ROA, that is called ROA. Now ROA number should be more than 1.5%. ROA number should be more than minimum 1.5%. This is our criteria. One is that sales growth or revenue growth or top line growth. This whatever you tell, this should be more than at least 14 or 15%. This is minimum, I am telling. The more it is, the better it is. And the second one is ROA should be more than 1.5%. If such companies you are finding, that will be the best for 10, 20 or lifetime investment. Now that is on you. I will share one screener on this video description box. These are the screener.in finance companies in India. Total 524 companies are there, 524. Here I have selected P ratio, market cap, return on asset and sales growth. All numbers are visible here. What you have to do is, you have to see ROA number should be minimum 1.5%. For Bajaj Finance, you see Bajaj Finance, the multi-bagger of last 10 years or 20 years, it is 4.4. That is why this is a multi-bagger. It is giving a tremendous, like huge ROA. This is what we are looking for. So if you get such numbers in some smaller market cap company, this is already 5 lakh crore company now. So for it to become 10 times, it will be very difficult. But for a smaller company, that will be easy. So this is the number you have to watch, ROA and sales growth. Sales growth should be more, like 25% is very good. So you can see for Bajaj Finance, it is already 28%. And it is not like once in a blue moon. It is consistent sales growth. You can see that last 5 years, this is the growth, more than 25% sales growth. So major chunk of that credit growth is going to such big companies, but the smaller companies will also take their part. When they will come in picture, that time they will also grow. So you have to look for finance company in next 10 to 20 years. I have explained you in a step-by-step manner. First is, India is a growing country. GDP is growing constantly from last 10 or 12, 15, 20 years, 6, 7, 8%. If that is the case, per capita income will increase gradually, and we will catch China $12,000 in the coming 20-25 years maybe. Then credit growth will also increase. Credit growth is approximately 2 times of the GDP growth. So 14% if credit growth is there, finance company will also grow by 14%. Some of the companies in finance companies will grow more, like 25-20%. We have to watch for them, and we have to watch that ROA number should be more than 1.5. The more it is, the better it is. So these two simple things you have to see, and then those stocks you have to buy in the decent valuation. Decent valuation you will get in market correction. When market corrects, your stocks you will get in low PE value and PEG ratio. PE divided by profit growth. That should be less than 1, PEG ratio. So this all, or if you are using some technical system like relative strength system, you can use that also. But these are the companies you should watchful and you should see for next 10, 20 or lifetime. So finance company you have to watch. Hope you like this video. If you are liking, consider subscribe. People should know that learning videos also gain views in YouTube and subscribers. So thank you for watching. We are going to complete, I think, 1000 subscribers. That's a great news. Thanks for your support to the channel. Share it with your relatives, friends, so that I will be encouraged to make more learning videos. We'll see you in the next video. Thank you.